Ashraf Damodaran, one of the best company valuators in existence, the dean of valuations, just came on mainstream media, both Bloomberg and CNBC, to say that he has never seen an investment opportunity as lucrative as this one.
I've never seen cash machines as lucrative as these companies are. And I don't see the cash machines slowing down.
For him to say that, him being such a cautious, conservative guy, to come out with this claim saying this is the most lucrative thing I've ever seen in my life, we have to talk about it. Absolutely. But as always, don't click nothing, don't smash nothing, don't buy nothing, just listen. At the end of this video, I'll also have a surprise for you. If you want to join the Academy and you want a huge discount for Christmas, it's going to be at the end of this video. But first, we got to talk about it. We got to watch the clip to understand what the hell he's saying. And then after that clip, I'm going to share my opinion, my strategy, my analysis. Let's hit it.
Are we too expensive now or are we all right?
Well, it's tough to follow back-to-back 25% plus years, right? If we hold up through the end of the year. I mean, I think we got really close in the 1950s and the mid-70s, but I don't remember the last time we had back-to-back years for the S&P 500, which were 25% plus years. I'd come down right in the middle. It is richly priced, but it's not bubble territory. I know people compare it to the late 90s. Here's the way I think about it. Am I going to sell everything and head for the hills? No, it's not that kind of market. Am I going to take every dollar of cash I have and throw it in the market? Not that kind of market either. So if I have cash, I might be a little more reluctant to put that cash to work in the market right away. But if nothing else, the last 2 years should tell us the cost of not being in the market. People sometimes ignore it when they think about being conservative and not going into markets. But you'd have given up 60% upside in the last 2 years by staying in cash. That's a lot to try to get back by market timing. You know what? I'll take 8 to 10% returns after the last 2 years. That would be good enough for me. I'm not trying to get rich in the market. I just want to preserve and grow my wealth. So I'm not looking even for double-digit returns. If I make 8 to 10, that's good enough. So I think that the AI architecture part, obviously, the chips, the cloud storage business have taken off. But the AI product and service, market's being pretty cautious about piling into those stocks. So the next phase of AI is, I think, the use of the architecture, whether it's software, the products and services that emerge. So that's what I'd be looking for if I'm looking in the AI space, is converting that architecture to actually making money off that architecture.
So the first thing he says here, which I absolutely love, is that, look, right now, everybody's saying that this market is overvalued. It's overhyped. It's driven by euphoric trading, and it has nothing to do with fundamentals. And that is about to cause a lot of people pain when the market actually corrects, explodes, crashes, whatever the case may be. And he says, look, it is hard to follow 2 consecutive years like we had of 25+% per year, 2023, 2024, to say that 2025 is going to be another 25% plus year, it is highly improbable. It is highly unlikely that we're going to have a third year like the ones we had over the past 2. Statistically speaking, historically speaking, he's absolutely right on the money. We almost have to play the lottery to see the same odds to get a third year of 25+% without a correction, right? But he also says that despite the market being priced on the top side, it is richly valued, as he put it, but it is not bubblish. It is not a bubble, and people who are comparing this market to 1999 don't know what they're talking about. This is not a bubble. And this is not me saying that, that's Ashwath saying it. Basically saying, look, it ain't a bubble. Sure, it's not cheap, but this is not a bubblish market. So given these circumstances, he basically has to answer the next question is, what do you do in this market? Do you just sell out and run for the hills because the market is just too expensive? Or do you go all in because the potential is insane? And he says, neither. I'm not going to sell out and I'm not going to go balls deep all in into this market. I'm going to be slow, careful, and methodic. And he also points out one of the most important lessons for long-term investors that I have ever heard, and this is the same thing that Peter Lynch has been saying for years. Is basically, look, waiting for a correction, waiting for a crash, it has costs, right? Being on the sideline over the past 2 years, waiting for the market to finally correct, cost you 60%. Literally. Peter Lynch said this years ago, decades ago. Waiting for a correction has cost people way more money than the corrections themselves. And that's what's basically saying, look, there is a cost to being outside the market, and that cost is not very efficient. I always want to be in the market, even when it seems a little bit richly valued. Now, he also says the fact that even if next year we're going to have 8 to 10% and not the craziness we've seen in 2023, 2024, we're just going to have an 8% year, that is still going to be awesome. Because we've gotten spoiled by the last 2 years, all of a sudden 8% seems bad. When Tom Lee came out with his assessment for 2025 just a few days ago saying, well, we're going to end 2025 at 6,600. That's about 8 to 10% from this point. A lot of people basically were disappointed. Like, what? Just 8%? And he's saying, look, guys, it's not bad. That's the annual average of the S&P 500. That means a correction is not going to happen in 2025. I hope we get 8 to 10%. There's nothing wrong about it. And he also talks about the fact that the AI story did indeed took off absolutely insanely. But he also says, look, folks, look at which companies actually enjoyed the most benefit in the stock market. It's the infrastructure play. It's the chips. Now, they have ran their course and they've been basically bought up the wazoo. Now, it's the turn of the software side. The infrastructure is there, and now it's the software that has to make the next run. And he talks about the fact that the software companies in AI are going to be the next beneficiaries of the next cycle. Palantir, anybody? I've been saying this for years. Palantir is the software, and it comes next right after NVIDIA deploys the infrastructure. Now, he also made a second video, which I'm going to play right now. That one is from Bloomberg, and then I'm going to summarize what he said in that video and give you a few important insights. Check it out.
If you think about markets, there are two games that go on in markets. One is what I call the pricing game. It's driven by mood and momentum, and there really fundamentals don't even matter there. And there's the investing game. You talk about fundamentals. The balance shifts over period. This is a pricing market. The reason I think fundamentals don't even come into play is when mood and momentum is this strong, they steamroll everything. So I think at the moment we have a pricing market where traders are driving the game. And traders really don't care. I mean, they might pay lip service to earnings and cash flows, but the truth is, they really don't care. It's all about mood and momentum.
Mood and momentum, and you see that for the MEG 7. No stopping the MEG 7. And you say, find that opportunity to own a MEG 7 stock.
Yeah, and I think in a sense, I have never seen a group of companies carry a market for as long a period as the MEG 7, or the FANGAM, as I used to call them in the last decade, carried this market. 15% of the gain in all U.S. equities across 7,000 stocks has come from 6 or 7 companies. The numbers are mind-boggling. You know, we're talking trillions of dollars in market cap added every year. The MEG 7 companies alone, if they were a market, would be the second largest equity market in the world after the US equity market. It's that big. But when you have mood and momentum, it's often built on some reality. The reality here is these companies are special companies. They've been able to scale up not just revenues and growth, but some of them are insanely profitable. NVIDIA has gross margins of 75%. I mean, that's outlandish if you think about it. You know, the operating margins are 60%. These companies, at least most of them, are cash machines. And so if you're thinking as a value investor, I've never seen cash machines as lucrative as these companies are. And I don't see the cash machines slowing down. I think the pricing might be getting out of control, but they are pricing in companies that are deservedly among the best companies in the world. Yeah, and I think it's been priced for perfection all year. And we keep our fingers crossed saying maybe there will be no correction. But there's going to be a cleaning up. Whether you call it a correction, there has to be a cleaning up. You cannot have back-to-back years like 2023 and 2024 and not expect something to be fixed leading into 2025. That doesn't mean you sell equities and head for the hills. But if you look at the earnings and the cash flows, the market is not just pricing in those earnings, but it's also pricing in an expectation that there will be no crises. And if you think about everything that's happened since 2008, the one thing we know, almost as a constant, every 2 or 3 years, something happens that's big and global. And I think you need to build that in, and the fact that the market is not building in is a little troubling, because you could say, what happens when you have that crisis?
So in this video, he basically says, look, folks, you can sit here and pray all day long that a correction will not happen. But it's not a question of if, It's a question of when. A correction is inevitable. At any point in the market, it can happen. And to say that it will not happen for the next 10 years is just impossible. It has to happen. But he also says that you don't have to sell out of this market. The same what he said in the previous clip from CNBC. And he says, look, the market in the short term is always going to be driven by mood, by momentum. And in the long term, it's always going to be determined by fundamentals. But right now, the mood, the momentum is so powerful that it literally steamrolls the fundamentals. And that's just the way the market is. It's nothing bad. It's just the way it is in the short term. A correction is going to fix some of it. He also says the fact that he's never ever seen a group of stocks such as the Magnificent Seven. A group of stocks that good, that lucrative. He has never seen it before. And I agree, we have never seen anything like the Mag 7 right now. And says, look, right now, the narrative is that these stocks are expensive. But the mood and the euphoria we're seeing from traders, from long-term investors right now, that is all built on something that's not just in a vacuum. The reason there's so much hype around these stocks, there's so much excitement, there's so much euphoria, because they are what he calls cash machines with insane profits, with insane margins. He literally said this in this interview. He says, look at the cash generation of the Mag 7. Look at the margins. He literally says, I have never seen company as lucrative as any of the Mag 7s. It's absolutely insane. And that is why these companies are not slowing down, according to Aswath. He's saying, look, sure, they're richly valued, which means they're expensive, they're not cheap, but they're not slowing down because these are the best of the best, the creme de la creme. These are the all-stars of the NBA. You know, the player needs to get to the NBA, he has to be top 1%, and then get to the All-Star game, you have to be top 1% of the top 1%, and that is the Mag 7 right now. They're just too good. Now look, what he says in this video is very, very simple. I'm going to summarize that in about 3 sentences. Look, he basically says that you shouldn't be outside on the sidelines watching in, despite how overvalued the market is, because the cost of doing so is just too expensive. He'd much rather you deploy capital slowly, carefully in this market, and speed up when the market corrects, which is exactly what I've been saying. DCA at all times, which basically means buy at all times. When the market becomes a little bit expensive like it is right now, well, you slow down. When the market dips, you speed up. That's literally what he said in this video. You have to be careful in the market like this. You have to be fearful when everybody else is greedy, and greedy when everybody else is fearful. That's from Warren Buffett. That's not Aswath. Now look, at the end of the day, every single smart long-term investor is looking in this market and saying, look, the correction is imminent, but with imminent, it can happen tomorrow or in 6 months or in 12 months. There's no way for us to know when this correction is going to happen. So there's no point to try and time it and guess where the top of this market is going to be. It is literally possible to do long-term consistently. Now, what you actually do is you look at this market, you look at the stocks you're investing in, and you evaluate each stock. As long as you still want to be invested in these stocks, in this index, you still want to keep buying even in this market. You may consider slowing down and actually doing half DCA if the stock, for example, is like 20% up over the past 30 days. But in general, DCA, ignore the price, ignore the noise, and just look at the fundamentals long term. And then thank me later. Now, as I mentioned in the beginning of this video, if you would like to join the Academy and pay a lot less than the normal price, in fact, 35% less, use the code TOM35 on Patreon when you sign up to one of the annual plans for Roik Academy or Elite Roik Academy. One of the annual plans, not the monthly. Annual plans, 35% off with the code TOM35. Thank you. I'll see you in the next one. Peace.